in my immediate circle, I know a handful of folks that purchase houses at 0% rates, or, they're paying 1.9, 2% interest on their mortgage, but they went variable. Something like 70% of mortgages in Canada, I'm speaking about Canada, were variable rate through 2022. There's some massive adjustments being made. There's a lot of items like that, like, debt that's not getting paid, new debt applications being rejected, people are being priced out of their own homes. And, banks have been pretty forgiving thus far, and allowing new homeowners to continue making payments non-adjusted, but increasing the amortization rate of their mortgages. I was talking to Danielle Park yesterday from Vancouver Park Investment Council, and she was walking me through how a handful of major banks have been extending amortization terms in Canada to 50, 60, up to 90 years. And now they're having to claw those back and push people into higher payments, but they're just trying to delay and kick the can down the road because they've probably got people in homes that they can't afford. And there's a bit of a wrecking ball coming.
Welcome to Soar Financially, everybody. Thank you so much for joining us. We have a doozy lined up for you today. I'm really excited to have this conversation. I'm really, really looking forward to it because it's somebody I've known for, what is it now? Actually, good question, because you entered the business officially in 2011, 2012, Jay. So it's been, since I started in mining. So it's been 12 years. I have to think for a second. It's been a while because time just flies. But I love watching, Jay Martin, who's our guest, grow in the industry, grow in the sector, and build a fantastic brand for himself, but also a great conference business and a YouTube channel. I have to admit, to take a peek at once in a while, get some ideas, and he's got some great guests on. Sometimes we take a peek over there. He's like, oh, who has he interviewed lately? And of course, like, how is he doing his interviews? Like, why not learn from others that are doing a great job and trying to improve yourself, right? So let me bring him on because I'm really excited about our discussion here, Jay. It's good to see you, and thanks for joining me here.
Yeah, it's greting to be here, Kai. I'm looking forward to talking with you, man. Can't believe it's been 12, 13 years, but yeah, I guess it has been.
It's been a while, right? So you took over the conference business in 2011 from your dad, I think, right?
That's correct. Yeah.
So it's been 12 years. Wow. Unbelievable. 12 and a half years almost. Insane. So time flies. But Jay, I want to have a bit more of a macro discussion first. Like, because you interview lots of fantastic guests, and if you're doing the same thing I'm doing, you're starting to take all the opinions you hear and form your own. Right.
Yeah.
And so I want to, pick your brain a little bit on what's the state of the economy right now? Let's start with that one, and then we'll dive a lot deeper in certain specific topics. But how do you rate the economy right now? How is it doing?
The short answer, Kai, is not good. That would be what I would say. Before I'll get into why, I would say that a mistake I see a lot of investors make, however, is putting way too much emphasis on the wide variety of economic indicators, right? What is CPI doing? What's the unemployment number, right? What's the Dixie say? All this stuff. And, we look at these metrics and then try to answer the question, are we in a recession? Are we heading towards a recession? All of this. When the higher utility question to ask is, am I in a recession? What's the state of my economy right now, right? What's the security of my employment, my income? What are my prospects? What's my portfolio look like? What's my wealth picture right now? What do I have on the safe haven side? What do I have on the speculative gamble side and all of this? Because, there's a lot of noise out there and it's hard to sift through sometimes. So having said all of that, I would say that I am preparing myself and my family for a pretty rough. I hope I'm wrong, but I just look at indicators like credit card delinquencies now hitting all-time highs, auto loan delinquencies now hitting all-time highs, new credit card application rejections hitting all-time highs. In my immediate circle, I know a handful of folks that purchase houses at 0% rates, or, they're paying 1.9, 2% interest on their mortgage, but they went variable. Something like 70% of mortgages in Canada, I'm speaking about Canada, were variable rate through 2022. There's some massive adjustments being made. There's a lot of items like that, like, debt that's not getting paid, new debt applications being rejected, people are being priced out of their own homes. And, banks have been pretty forgiving thus far, and allowing new homeowners to continue making payments non-adjusted, but increasing the amortization rate of their mortgages. I was talking to Danielle Park yesterday from Venable Park Investment Council, and she was walking me through how a handful of major banks have been extending amortization terms in Canada to 50, 60, up to 90 years. And now they're having to claw those back and push people into higher payments, but they're just trying to delay and kick the can down the road because they've probably got people in homes that they can't afford. And there's a bit of a wrecking ball coming. So look, like what does that mean for me? Like, I think it's a smart time to be really patient in the market. It's a smart time to have a lot of confidence in the moats that you built around your castle. So whatever that looks like for you and your portfolio and your personal wealth picture, what's the safe haven, what's the stable assets you built around any speculative gambles, around anything that is a bit more volatile. And, have you built insurance policies into your portfolio right now? And, frankly, because of the people I interview on my show, I began thinking very critically about this in 2021. A lot of the thought leaders that you and I talk to are generally quite early on their doom and gloom forecasts. And you have to be wary because the doom and gloom forecast business is a great business to be in. You don't really ever have to be right, but you keep people's attention all the time. So, approach that one with caution. Having said that, enough people that I do trust and respect their track records convinced me that it was time to de-risk, 18, 24 months ago. And I began doing that. And so that for me, Kai, that means like pulling cash out of anything. I don't have any cash in the broad equity sector. And typically I don't, but I had a bit. I like to be quite barbelled in my approach. And the two barbells are, incredibly stable, boring, safe haven assets on one side. That's things like cash, land, and gold, frankly. And then on the other side, I like very asymmetric speculative bets. And my safe haven bucket is larger than it's ever been in my life, even as a percentage of my whole wealth picture. Because I've got 3 kids, I feel like this decade thus far has been incredibly volatile, but I don't think it's done with us. I think if you look at every single year thus far in the 2020s, it's thrown a new haymaker at us, right? Beginning with, a global economic shutdown in response to a pandemic in 2020 and 2021. We had civil unrest explode in the US and spread around the world. 2022, we saw a hot war break out. I don't think this decade is done with us. Unfortunately, I think there's too many unstable threads and narratives, and it's a good decade to be very cautious, very patient. And for those that are cautious and patient and can maintain some liquidity, there's going to be massive opportunities, but take your time and move slowly out there right now. And I don't mean to shatter people's confidence in their future. I'm a perpetual optimist, believe it or not. And I'm long human ingenuity and progress. I think my kids will grow up in a better world than I did, but there's always volatile seasons, through every century. And I feel like we're in a pretty deep one right now.
Extremely murky out there. And I was, we get so many impulses into our daily lives, as you said. Like, there's so many things we pay attention to that actually don't really matter to us. Like, you watch Bloomberg in the morning and you feel like panic selling everything every morning, right? So you catch my drift. But I love how you brought it down to the personal level, right? The smallest of micro levels. I've noticed myself, actually the last 12 months, how my spending habits have changed a little bit as well. Just watching what's going on in the world, just being maybe even a bit more cautious. Have you noticed something there yourself? You brought it to the personal level, so I got to ask that personal question. But have you noticed how your spending habits change a little bit over the last 12, 18 months?
They probably should. I'm watching our grocery bill shoot up. Things like this. I mean, yeah, I'd say, what could I tell you, Kai? I run a couple small businesses. I could tell you that more clients have asked me for extended payment terms in the last 6 months than I've seen in years. I know I'm not unique in that. I'm part of an organization called the Entrepreneur Organization, which is a global group of about 12,000 business owners. And there's a Vancouver chapter, Vancouver, British Columbia, of which I'm a member. They're all 7-figure founders of small to medium enterprises. And what I just described is very comparable. Everybody's AR is being stretched more than it was 2 years ago, more than they've seen it recently and in the last few years. So everyone's feeling a bit of a pinch. Everyone's holding on to cash. And frankly, they're smart to do so. A lot of my clients are in the public venture capital space, right? Public venture listed companies on the venture exchange up in Canada, or, the OTC in the US. And they're very penny and pound conscious right now, which is exactly what they should be doing. You don't want to be desperate for cash in this environment if you're a small venture public company. So, being very conservative, counting every penny. I mean, as well as I do, and I'm sure your audience is familiar, just given, who you are, that in the junior mining industry, the most important resource often is not what's in the ground. It's what's in the bank account, right? It's cash. It's hard to get, hard to keep. And so, I'm seeing the smartest companies in that sector be very conservative right now. And I love seeing it, as a shareholder of some of these companies. It's the right time to do so. You mentioned Bloomberg, right? And I just want to go back to that because you're absolutely right. I think it's good to be practical about our outlook, and we might be looking at a tough 10-year period, and let's just get real about that, because markets don't just go up as they have for the last 15 years. I mean, there's a lot of investors that are kind of new in the business who have only had one experience, right? And that's that markets go up, and sometimes they correct and then they go up again, and that's an anomaly in itself. And so if we're going to learn the other side of that cycle over this decade, so be it. It's not necessarily all bad. It's normal. It's cyclical. And companies like Bloomberg, that's, the What's News podcast. It's a Bloomberg podcast, and I listen to it. It's interesting. It's a good 15-minute bit to put on my commute to the office. But it's their job to come up with a morning and an afternoon headline every single day. They have to come up with front page news twice a day. And as well as I do, there isn't front page news twice a day, every day. But these media companies are in the business of providing that. And so they will find it, right? Whether or not it exists, they will sensationalize something to make it front page news for that morning or that afternoon distribution. And their business case relies on it. But that doesn't mean it's in your or my best interest, right? And so, even though I do tune in to, a couple publications like that daily, I really try to police my emotional state when I'm reading these headlines. And the content that I put far more emphasis on are, a couple writers that, like, I love Luke Groman's Forest for the Trees. It's a Friday distribution. The benefit of a weekly distribution is that you give every story 7 days to settle, 7 days to determine whether or not there's actual longevity, legs, and substance there, because it's got to survive the other 6 days of the news cycle and still remain at the top. And, it's a good vetting process. And, the monthlies, I think, are even more valuable. Grant Williams publishes monthly. Lynn Alden publishes every 6 weeks. I put a lot of weight on those reports because you've had 4 weeks or 6 weeks to sift through the noise, and what's left from their perspective, and they're not always right, but what's left from their perspective is the signal. And so, weekly, quarterlies, weekly, monthly, quarterly publications should get more investors' attention than they get currently. We get pretty sucked into daily headlines, and I totally understand. It happens to me too, but it's often not in our best interest to let that occur.
Absolutely, yeah. CPI data was released this morning, and it's of course the biggest thing ever, and of course they missed expectations. So, and the market is in an upheaval, at least the first 20 minutes, and then it figures out actually what it means and goes back to normal, right? But massive breaking news.
Well, it's a good example that you brought up there, right? Because, there should have been this upheaval. There wasn't, this and that and this and that. It's like, Kai, if you were sitting at your desk in January 2022, we're sitting at zero rates, right? And somebody had told you in January of 2022 that by the spring of 2023, the Fed funds rate would be 5.5%. You would assume that markets would have free fallen. We would have seen something, cataclysmic correction comparable to the worst depressions that we've ever read about. And frankly, it hasn't really occurred, right? And I think there's a handful of reasons for that. And I think there's still damage to be done to the market. I believe that. But, there's a long-term view of like an event that occurred, and had you known about it in January 2022, we would have made all these assumptions of what was going to happen immediately. And rarely does the world work like that, right? Things take time to settle and trickle down. Yeah.
Absolutely. Yeah. And I'm trying to bridge, the gap a little bit, because we're both really active in the junior mining space, right? Most of your exhibitors are junior exploration and junior mining companies as well. So I'm trying to bridge the gap from the macro to our micro level a little bit as well, and how that is affecting it. You brought up January 2022 conference, great mood, right? Or did you? No, you hosted in June that year.
Well, we were
So,
scheduled for January
and
2022, and on December 18th of 2021, we had to postpone it, just given
given the
some
fact, yeah.
some
No,
clown show stuff that was occurring.
so, but my point I was trying to make is things changed drastically in March 2022 when the Fed started raising rates, because all of a sudden investor wallets just were shut for our sector, right? The money dried up. So the question is, like, I'm trying to, sort of where I'm trying to get to is, like, how much longer do we have to suffer in this sector, based on your opinion? Like, simplified, how much longer do we have to suffer, Jay?
Yeah. Yeah, I don't know the answer, Kai, but here's how I action my unknowing, I suppose. This sector, okay, so it's easy to hear an expert in the junior mining sector tell you that it pays to be a contrarian, and tell you that it pays to be brave when others are scared, tell you to buy stuff that people hate, all this stuff. It's easy to hear that and be like, yeah, that makes sense. I will do that. But actually doing it is a whole different story. Right now is when that occurs. And so that's what I'm doing. I am taking all the advice from my mentors and, that I've been fortunate to have over the last 12 years in this business. And I've looked at when they've made their fortunes. And it's when everybody's running for the exit and everybody. So right now, for example, frankly, Kai, I love this market. I'm just going to be honest. I love this market because I'm walking into mid-tier gold producers with no competition, getting great deals on the open market because everybody hates this industry right now. Now, I write about this in my newsletter, right? And I always mention if I'm allocating cash, where to and why and all of this. But I always add the footnote, this does not mean I'm expecting this industry or this company to take off this quarter or next or the quarter after that. What I'm saying is that it's undervalued today. And because I'm not a trader, I'm a long-term value investor, right? I'll be here for the long term. And I believe that this is a company run by a CEO who's had 3 or 4 wins under their belts, and success begets success. I think they've got great assets and a great management team and amazing prospects, but nobody cares right now. The market hates this sector as a whole. And so companies of high quality are getting incredibly punished. But that's our opportunity if we can be bold enough, if we have the liquidity available to make those moves and then step back and wait and apply patience as our next trade, right? Which is the harder of the two. I don't know when junior mining will get some love, Guy. I think
patience is a tough one. Patience is a very tough one, especially since we've been suffering for, let's say, 18 months already, since March last year, right? So
yeah, it's been very dry. Liquidity's been very tight. And, if you look at all the factors we opened up this conversation with, credit card delinquencies, auto loan delinquencies, mortgage rates pricing people out of their own homes, all of this. What does that tell you about the near-term availability of risk capital? Like, I don't know, when it turns, it'll turn fast. It typically does, right? When we've seen these sectors turn from a bear to a bull rally cycle, it happens fast, which is why those investors in this sector who have become household names, like the Rick Rules, for example, this is the strategy they employed. They were buying when nobody else was in the room. And by the time the market turned and everybody shows up, and your podcast and my podcast, 10x in listenership, right? The veterans have already placed their bets 6 months earlier, and so that is the strategy that I'm trying my best to emulate right now. Absolutely.
what's the best advice you've gotten over the last 6 to 12 months?
Ooh. The best advice I've gotten over the last 6 to 12 months. I don't know if there's one thing, Kai, but it would come back to, here it is. Actually, here it is. It is the winning bet is duration. And this does tie to the conversation we just had about patience and long-term time horizons and all of this. But you know what the number one asset that most investors ever end up owning is over the course of their lifetime? It's their principal residence. Now, that's not because housing always outperforms the market, because it doesn't. Sometimes it does, and sometimes it doesn't. But the reason the principal residence ends up being the best investment of their lifetime is because it's the one investment that people hold for 25 years. Duration is why it wins. Now, you can look at an investor like Warren Buffett. He's the most famous investor that's ever walked the planet. The number one reason that he's a household name is because he's been an investor for over 80 years. Now, I'm not taking anything away from his strategy. He's brilliant, clearly. But had he employed the exact same portfolio strategy, but started when he was 30 and quit when he was 65, he would be worth less than 1% of his current net worth. And none of us would have ever heard his name. But because he started in his early teens and is still going in his 90s, he is the Oracle of Omaha. But it comes back to duration, right? And you just said it. Patience is the hardest part. That's how you get to duration. But duration is a competitive advantage that any of us can tackle, right? Yeah, it takes strong will and takes some practice. You're not just born to weather incredibly volatile cycles when it comes to your net worth. It's not easy to do. It's very hard to do. It never gets easier in my experience, but it's worth working towards because that's where serious money is made. And so, I would say that's a lesson that's been reaffirmed to me, a handful of times and with huge emphasis over the last 12, 18 months has been, this is a time for patience and thoughtful movements and a time to always reflect on your time horizon. Because if you're confident in your time horizon, then short-term volatility shouldn't bother you. You should be able to look back and say, well, yeah, I'm down 20% on this investment 4 months after I purchased it, but my time horizon's 5 years, 3 to 5 years, 5 to 10 years, whatever. So why should 4 months matter? Does it affect my thesis? No, it doesn't. I still believe in this bet. There's some short-term volatility, but it's irrelevant given my time horizon. So patience and duration, I would emphasize those two.
When you're deploying capital, what part of the market are you putting it into? And I particularly mean the mining stocks, like in the mining sector. Like, what are you gunning for? Like, is there a particular sector that stands out? And I'm thinking of the lithium, the battery metal space. Is it more the precious metals, gold, silver, or base metals, or even the combination of copper and gold, for example?
Yeah, right now I am pretty overweight gold producers, Kai, right now. And I'm overweight gold producers for the reasons that we've been talking about, that I can buy names that are incredibly undervalued, run by CEOs with great track records who have put the puck in the net on 3 or 4 previous companies. But as a consequence of market sentiment, nobody cares right now. And so I just feel like those opportunities get handed to you a few times in every investor's career, and it's up to you whether you have the stomach to chase them down. But that's where I'm putting cash right now. And, time will tell if I'm smart about that or not. But, I've got a high conviction in the long-term gold thesis. And you can look a variety of directions there. I am not a perpetual gold bull. I should emphasize that. And I think that anybody, maybe I'll just leave it at that. There's a time to own gold and there's a time not to, right? And Luke Gromen says it beautifully. There's very few moments in history when owning gold is valuable, but during those moments, it's about the only thing you want to own. And those are typically at the end of or during, major world wars, massive geopolitical fracturing, excessive tension on the world stage. Any of this sound familiar? Like we're in a pretty interesting time. So having said that, I own a lot of physical gold, but I am overweight the gold miners right now, just because of the torque that you can accomplish with the gold equities. And I'm buying gold producers because they're incredibly cheap and they're cash flowing and they're well run and their balance sheets are stronger than they've been in 12 years, but their prices don't reflect that yet. And logic tells me eventually they will if I can be patient. I'm super bullish on, the whole commodity sector as a general thesis because the industry has been so starved of capital. Sorry, when I say commodities, I'm talking about hard commodities. Let's just say precious and base metals, stick with that. Because the industry has been so starved of capital for so long that we're going to see the whipsaw effect. We're going to see a slingshot. Whether you're looking at copper, nickel, graphite, lithium, sure, vanadium, magnesium, all the energy metals, or you're just playing it safe on the energy trade and sticking with, the stalwarts, copper and nickel. I think those are great places for capital. I have some concerns about sort of the near term, global recession activity and what that will do to near term demand. So, we may see a better buying opportunity. I don't know. We may see a better buying opportunity in the copper nickel space over the next year. But as a course of business, I never try to time markets. And so I am holding some exposure to copper and nickel as well right now. And if that market corrects before it goes up, I kind of feel the same, about that, is that, well, it doesn't matter because I'm not a short-term trader. I'm a long-term value investor, and included in being a long-term value investor is sucking up some volatility when it hits you. So I think that, Kai, you and I, we've lived our entire life in an era of increased globalization, increased pooling and sharing of resources. Anything you wanted to buy, if you had the cash or access to the credit, you could, from a sovereign nation standpoint, right? Resources were being pooled and shared around the world. It was an era of trust, fragile as it might have been, it existed. And that era is over. That era of trust is for sure behind us. And what happens next is not going to happen quickly. It's not going to be simple. It's not predictable. I don't know how the chess pieces are going to fall, but I do believe we're entering the next era, right? And whether that includes the fall of an empire and the rise of the next one, I'm not sure if it'll be that dramatic over the next 5-10 years, but that's also coming, by the way, during my lifetime. I firmly believe that. And when those shifts happen, the supply of everything becomes unpredictable and incredibly vulnerable. And so, every country, every sovereign nation, every mega corporation will be fighting to secure their supply of the key commodities they need to keep living the life that we want, right? Like, human demand for stuff isn't going anywhere. And on a long-term trend, like I said, I'm a perpetual optimist. I'm long human ingenuity and progress. And my kids and my grandkids will have a phenomenal life and probably, better access to a wider variety of goods than I had. Between now and then, there might be some volatility. And in those volatile moments, especially right now, I think commodities are a great place to be, just because everyone's going to be fighting and continue to fight to secure their supply chains. And, there's a couple thoughts. There's a couple thoughts in that portfolio right now.
Yeah, interesting. Like, commodities are an interesting topic because we discussed that before hitting the record button. Like, commodities really affect global politics. Like, the geopolitics are driven by commodities and vice versa, right? There's often in that pair trade. We've seen a lot of volatility. Let's use that word when it comes to oil, right? And tumult, and people have gone to war for certain commodities. We haven't seen it in the base metal space yet. Do you think that I don't know? Maybe I'm getting too far ahead of myself here yet. But are we ever going to fight a war over copper?
I wouldn't be surprised, Kai. I mean, we've fought wars over precious metals in the past. As massive conquests and the uncovering of new continents. It drove global exploration. The same era, we were also fighting for spices, right? Yeah. Things happen. Yeah. Weird things happen. We look at them as weird. They're not weird in the moment, but
no, good point. Good. Yeah, it's a possibility, right? So, I think you mentioned, touching on like the time we're in right now, the last 18 months have actually also been a great time to educate yourself, right? And learn, because the markets have been slower. And one of the reasons you're running your YouTube channel, you run the conferences as well, is to educate as well, to pass on the message of what is happening, of wealth creation, but also just fundamental education. Like, what are we actually doing in mining, right? Also attracting a new audience, because we both know it used to be more the older generation I was interested in gold for wealth preservation, and that has lived through different cycles, right? So what are you doing, or what can we do to attract the generation that hasn't been through the hard times, like a global financial crisis, an internet bubble burst, and things like that?
I think it's happening, Kai, to be honest with you. And the reason I would say that is because, yes, I run a annual conference in Vancouver, British Columbia, called the VRIC. It's very focused on investment in the precious and industrial metals sector. And last year, January 2023, we set records for attendance, and not small records by a wide margin. But what was most significant about that was the most common question that I got asked on the show floor as I was walking around just chatting with people. And there was, several thousand people there. Were sort of around 6,000 investors at this conference. The most common question that I got was, how do I get started? And it came at me in a variety of forms. Who should I start reading? How do I start selecting companies that I should look at? Or how do I get started? It's some variation of that question. How do I get started investing in the metal sector? Now, that's a humongous question, right? You could give 100 different answers and they could all be right and valuable. And but the point is that, the people that were asking me this question were as young as 18 years old, walking around a metal investment conference, right? You're right. We haven't seen that in the
Ever.
last 15
Like, at
years.
least I
Yeah,
haven't in my last
exactly.
12 years
Yeah,
of being in the business.
100%, 100%. And so, I don't know so much if it's about like, how do we attract the next generation? I think they'll find their way here. An example I would use is, I also run a YouTube channel. We focus on macro. We've seen a lot of growth over the years, but there's periods where you just skyrocket. And, in macro, that was like the summer of 2020 into the fall of 2020, because the sky was falling, the future was uncertain, crazy things were happening, and an insanely large percentage of people suddenly turned their attention to macro because they wanted to know what the heck was happening, right? And why was it happening, and what's behind these policy decisions and all this stuff. And there was so much madness that the attention suddenly pivoting to macro was like a tsunami. And we're seeing that now occur in the commodity sector on the back of the end of globalization and this new geopolitical world order that we're looking at, right? The rise of the BRICS, the de-dollarization of major economies, and all of this, and what does it mean? And people are starting to understand that, for a country like Russia, their currency is oil. That's their currency. Oh, oil can be a currency. Well, it is in Russia, more or less, right? That's their reserve currency. And when you start to think about the world through the lens of the supply and demand of commodities, the distribution of power makes a lot more sense. And there's more and more people right now who are curious about the distribution of power for obvious reasons. We have hot wars breaking out that are looking like they're going to escalate. So understanding, who wields significant influence has probably never been more important. And the shortcut to understand a lot of that, not all of it, is to understand who has the supply, right? And who has the demand. And there you'll find a lot of the distribution of power, influence, and wealth, right? And so, I think these factors are occurring. People are paying attention, and they're finding their way to the commodity sector as a consequence of that. So the next step is like, okay, how do we set, new investors up for success, right? Because it's a treacherous market, especially if you want to start stock picking. I mean, it's a very tough game. And there's a lot of sharks in the water, frankly, right? Like there just is. So be wary out there. A lot of fake gurus and all this stuff. And so, in answer to that, I'll self-promote here if that's okay with you.
Go ahead.
We just assembled a course, an online course called the Commodity University. And it's 10 chapters. It starts, Kai, super fundamental. The first question in chapter 1 is, what is a commodity? And from there, we go through basic supply and demand dynamics, risk factors, geopolitical influences, a bit of history. We go deep dive into this, a chapter on gold, specifically on silver, copper, uranium, and then a chapter on energy metals. So we cover the commodities, the metals that are most talked about from an investor standpoint. And then at the end of it, we're right into portfolio construction. So here are the vehicles you have in front of you that you can choose from, ETFs, buying physical, choosing stocks, et cetera, but it's built for that new investor. And the purpose of it is like, I want everybody who consumes this to leave, having completed it, being able to carry on a highly intelligent conversation about investing in the commodity sector. They now know where to start, right? That's the goal. And it's like, we're just launching this at the end of the month. Anybody who wants to hear about it, just find me on Substack, J Martin Letter on Substack, and the announcement will be there as we're building it. It's been super fun to build. By the way, but I'm seeing a lot of initiatives like that too, Kai, where people are kind of owning the education experience and trying to mentor the next generation of investors. As you and I were so fortunate, so it's time to pay it forward, man. And
absolutely, it's actually quite an humbling experience because I've done the first mentoring session, I wouldn't even call it, but I had somebody reach out to me the other day, and we went for a walk along the seawall, and super interested, 21 years old, whether he should get into mining. Right, so I was like, all right, maybe not right now. Wait a minute, right? But it was a really interesting, humbling experience because really well prepared, like training it to be an accountant, and then just curious. That was fun. While you were chatting, I pulled up my my YouTube analytics because I thought I was curious. I wanted to see the age and gender distribution, especially the age distribution. And just looking at it, it's 25 to 34-year-olds, is 7.2% of the channel that have watched videos over the last 28 days. 35 to 44 is 15, and then, of course, the rest is 45 plus. think that's interesting because I could have sworn it would have, if I would have had to make a bet, would have figured it might be lower. But I think curious what your metrics are as well in that regard, because we talk a lot about mining and commodities and geopolitics. So having 22% of our viewers below 44 of age, I think that's interesting because that's the new generation investing into our space. And I
Yeah,
could have sworn that portion would be smaller. Like if you would have put
right.
a gun to my head, I would have said, maybe 10 to 12% in total, right?
Yeah, yeah, I love that 22 age group and even younger, man. It's very cool. I imagine our makeup, well, I know our makeup is quite similar. The point I'd make though is that our growth is coming from those younger demographics, right? So you said I think 22 to 34 and 34 to 45 or something like this. If our makeup is similar, probably like the growth, however, is coming from very specific segments of that population.
Interesting. Like diving into the specifics here, right? Fantastic. Jay, it's great having you on. Right? Absolutely
Yeah.
love the conversation. We jumped around a little bit, but there's so many questions I could still ask you, like your personal growth story. Like we got to do this maybe in person when I see you in Vancouver in January. I'll have you over at the studio and we'll do a deeper dive into Jay Martin himself and how mining has shaped you and your personal growth, right, as well. So I tremendously enjoyed that conversation, Jay. I can't wait to see you again in January in Vancouver. And where you sort of mentioned it already, but where can we find more of you?
First of all, Kai, the pleasure's all mine, man. Yeah. So good catching up with you, buddy. Can't wait to see you in person. I look forward to doing that and hooking up at the VRIC in January. For anybody who's interested in what I do, I'm pretty easy to find. It's the Jay Martin Show is my show on YouTube and wherever you download your podcasts. The Jay Martin Letter on Substack. I publish every Sunday. It's arguably my favorite thing that I do. I love writing. And, I don't necessarily talk about managing money. I more talk about managing my mind, which I think is the most important tool in every investor's toolkit.
I need some mentoring there, by the way. So,
well, we spent a lot of time discussing the biases, heuristics, and blind spots that lead to investors' best and worst decisions. The audience loves it. We've got about 40,000 investors that tune in every Sunday. So hit Jay Martin Letter on Substack to get on that distribution list. And then the conference is a different business. You can find that at cambridgehouse.com. We are in Vancouver, British Columbia every January, and we build the Super Bowl of junior mining finance. We'll have 6 stages circulating in the main floor of the Vancouver Convention Center, about 350 junior mining companies on the show floor, 120 keynote speakers, many thousands of investors. And it's great. It's a good time. It's lots of fun. There's personalities in the sector that you want to meet. What's so nice about and what we really, push forward with these is, you might have been listening to Rick Rule interviews. You might have been watching Mark Moss YouTube videos or George Gammon or whoever. They're there and they're keen to meet you, and so we make a point of making sure there's multiple activations where if you want to connect with Peter Schiff, Peter Schiff's there to shake your hand to have a conversation. So even though it is scaled, it is quite large. We really put a lot of energy into making sure that people who want to connect with those on the podium get that opportunity. And in addition to meeting other companies, of course, and investment opportunities on the show floor.
Fantastic. Yeah. I've been going for 12 years now, I think, as well. So with only one interruption, obviously. So really appreciate it, Jay. Thanks for coming on. It was insightful. We jumped around, but I tremendously enjoyed it. So can't wait to have you back. And everybody else, thank you so much for tuning in. I hope you enjoyed this conversation. You can probably tell that I've known Jay for a while, and there are a lot of topics we can touch on. We could have even dove deeper into the macro discussion of what is going on. Like Jay knows exactly what is happening. He interviews great minds on his channel as well, and he has his own opinions, of course, as well. But he also gets influenced by all the other opinions as well on his channel. It's absolutely fantastic to hear. Go join him follow him on Substack. Go follow him on Twitter. Go attend the conference in January. I'll be there as well. I'm really looking forward to that as well. I already blocked it off in my calendar. I haven't booked the flights yet. I actually need to get on that soonish here as well. So make sure to do that. And while you're at it, subscribe to the channel. 83%. I just looked it up. 83% of you are not subscribed to this channel who are watching. Let's change that. I want to keep bringing fantastic guests on, just like Jay and other guests of great caliber as well. Really helps us. Thank you so much for tuning in. We'll be back with lots more. Thank you.